Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 160th episode. Today, it's all about stablecoins, the idea and practice of which have been around for a while, but a few things have happened this summer that have made this matter catch major momentum. To parse through these developments, outlook, and risks, we have with us Eswar Prasad, Tolani Professor of Trade Policy and Professor of Economics at Cornell University. Eswar is also a senior fellow at the Brookings Institution, where he holds the New Century Chair in International Economics. Eswar, a warm welcome back to Kopi Time.
Nice to see you, Timur, and I guess we should also let your audience know that we used to be colleagues at the IMF. Those were good days indeed.
Those were very good days, and I look forward to running into you in Washington in April and October during the IMF spring and annual meetings when we invariably are there. Eswar, what is the Genius Act and why is it consequential?
So stable coins have been around for a while, Timur, and maybe it's good to start off with what they are. So when we think about the cryptocurrency revolution that started in 2008 with the creation of Bitcoin, the idea was to create a payment mechanism that could avoid having to use banks such as your bank, credit card companies, or other traditional financial services providers. Now, it turned out that the Bitcoin technology was really very cool and actually worked in some ways, but unfortunately, Bitcoin has not proven to be a great medium of exchange, a payment mechanism, because of its very volatile value. So stablecoins essentially provide that stability. They are typically backed up by stores of fiat currencies, either government bonds or cash or other types of liquid securities that allow them to maintain value at par relative to some major fiat currencies such as the US dollar. Now, stablecoins operated in a somewhat gray area for a while, and this was a problem for stablecoin issuers and even traditional financial institutions that wanted to consider using them. What the Genius Act has done is basically, in my view, legitimize stablecoins while giving them the benefit of light touch regulation. So essentially, stablecoin promoters have for a long time been clamoring for regulation that would give them a lot more legitimacy. Now, it's worth thinking about one of the key functions of stablecoins. Stablecoins, of course, work well as a payment mechanism in decentralized finance that takes place on blockchains outside the traditional financial markets. But stablecoins also play useful roles for cross-border payments, and especially as a bridge between traditional finance and decentralized finance. Now, this was a problem for stablecoin issuers and those who wanted to use them, which is that without the legitimacy provided by government regulation, traditional financial institutions like commercial banks were very hesitant to have any sorts of dealings with stablecoins. So, what the Genius Act does is basically to legitimize stablecoins by laying down the rules about what sort of backing stable coins should have, what sort of instruments are going to be considered, who is going to regulate them, and also who can issue them.
Right. I want to sort of break those things down a bit. So, of course, Genius Act is about stablecoins backed by U.S. treasuries, mostly issued by U.S. companies under some degree of supervision by U.S. regulators. How do you see the weeks or a couple of months since the Genius Act was passed, the ripples that this act is creating across the global financial and regulatory landscape?
It's creating a great deal of fear around the world, Timur. And the reason for that is simple. One of the key elements of what stablecoins are doing is basically showing how you can use new technologies, especially blockchain-based technologies, to make payments much more efficient, either within a country or particularly across borders, because cross-border payments tend to be quite expensive, tend to be very slow to be done. They tend not to be very efficient or user-friendly. And stablecoins make it very easy to use this method of payment that is going to hold stable value relative to a currency like the US dollar very easily for cross border payments that basically get settled within practically an instant. So, this is creating a lot of fear for a variety of reasons. Among central banks around the world, it is creating the concern that this might be a way that the dollar indirectly becomes even more dominant than it already is in payments. Take even a very advanced economic area such as the Eurozone, which of course has very high per capita incomes, has a common currency, but what it lacks is a unified payment system across the entire zone. So if you want to use a German bank account to make a payment in Germany, it's easy. If you want to make a payment in Greece, it's a lot harder. So for cross-border payments, traditionally Europeans have had to rely on credit cards that are, of course, linked to their bank accounts, but are issued by American companies. Now, if you have stable coins becoming very easy to use across the entire Eurozone, there is a real concern that dollars could start playing a bigger role even in the Eurozone. But now, when you start looking at countries that have less credible central banks, less credible currencies, there is a real concern that those could be swamped or basically swept out of existence by people who far prefer to use dollars. And it's stable coins that could be issued not just by the existing stablecoin companies like Tether or Circle, which are the major players in the stablecoin territory right now, but through the Genius Act, it could be American financial companies, American banks, even potentially one day American corporations like Amazon, for instance, that have a worldwide reach, very deep pockets, and might be much better trusted than the central banks of many countries. So essentially, a lot of change is coming, and it's forcing central banks and commercial banks to basically respond in ways that they should have a long time ago. And what I think is a real benefit of stable coins, their true legacy is going to be that they're forcing central banks and commercial banks to improve their game.
Sure. If you and I were discussing the digital asset space a few years ago, we probably would have spent more time discussing CBDCs, central bank digital currencies, as opposed to stable coins. Now, the Genius Act is basically ruling out the US government being in the CBDC business and allowing US private sector to go forth and multiply as many stable coins as they want, provided they have some degree of oversight and backing by US treasuries. Haven't we seen this movie before? Wasn't China allowing the private sector to issue a great deal of credits and advances, like I'm thinking about Tencent and Alibaba and so on, that at some point about 5-6 years ago, they got nervous about losing control of money supply and they clamped down very hard. Is there a risk that the US would go in that direction? I mean, would the Fed lose control of money supply if it were to allow all these stable coins to proliferate?
Directly, perhaps not. If you think about money creation in a modern economy, um, some of that is created by central banks, what we economists call outside money. That is money that is in net positive supply outside the private sector. However, in most modern economies, it's really commercial banks through the issuance of credit who create the most amount of inside money. And it's called inside money because it's created by one part of the private system where it is an asset and it is used by another part of the private system where it is a debit. So it cancels out on net within the private system. But it is the creation of credit by commercial banks that really powers modern economies. So there are some interesting sub questions that come up from your question, Timur. One is, will the emergence of stable coins, in some sense, be a new mechanism for the creation of outside money? And second, will stablecoin issuers threaten commercial banks in any way? And will that affect the creation of outside money? And this is where things get a little wonky because one can think about stable coins at one level as essentially narrow banks. They're not creating new credit, but they are taking what are effectively zero interest deposits from customers and then lending them out to be used for payments and so on. So they're not really creating new credit. Now, could one argue that these stablecoin issuers, whoever they might be, are in some sense creating outside money? Now, this is where things get very interesting. If you think about what the backing of stable coins is, then it turns out to matter. Stablecoin issuers, in principle, could hold any liquid security or cash. So if you think about literally a stablecoin issuer backing up a unit of a stablecoin with cash, that doesn't really expand the use of cash in the economy, although it does mean that cash is essentially being put on a blockchain-based financial system. But what if that stable coin is being backed up by a treasury security? Now, essentially, what you've done is you're taking a treasury security and converting it into a means of payment. Now, traditionally, in the US and elsewhere, you don't use treasury securities issued by the US government as a means of payment. It is a store of value. But now, stablecoin issuers could essentially be tokenizing, that is converting into digital tokens, US Treasury securities. So now you're creating a new payment mechanism which did not quite exist. But again, things get even wonkier when you think about whether we should consider this money or not. It is certainly a means of payment. Now the question is, whose liability is this? If you think about traditional payments in a modern economy, you have currency issued by the central bank. There is a liability of the central bank that can be used for payments. If you think about bank deposits, which are traditionally used for payments as well, those are a liability of the commercial bank, but those two trade at par because most commercial banks are covered by deposit insurance, and we trust in most countries that these two instruments, bank deposits worth $1 and currency worth $1, are going to trade at par. Now you have this new element appearing, stable coins that we believe are going to trade at par with money. But the question of whose liability they constitute becomes very tricky, and it depends on what sort of backing they have. So now we're getting into quite uncharted territory in terms of what is going to happen to the money supply. But there is certainly a concern about what could happen to commercial banks because right now, stablecoin issuers are not allowed to offer any interest on stable coins. So essentially, one can think about it as a zero interest bearing deposit account that you can then use for payments. So obviously, commercial banks, which can offer a positive rate of interest, are going to have an advantage. But in a low interest rate environment, or if the Trump administration were to decide that it wants to be even more crypto friendly than it already is and allow stablecoin issuers to start paying interest, then you could have commercial banks facing a real challenge. And commercial banks are already facing a challenge because one element that gives them a fair amount of revenue is payments, especially cross-border payments, where they collect fairly significant fees, and all of those are being whittled away by this new competition. So commercial banks are under real threat right now. Some of them are responding by tokenizing their own deposits, making them easier to use. But now you could enter a situation where stablecoin issuers start displacing commercial banks, at least to some extent. And that could raise this interesting question, who is going to start creating credit in an economy? So there are lots of ripples and indeed tremors coming to both domestic finance and also to the international financial system.
I remember in the aftermath of the global financial crisis, when generally the regulators were deeply aghast by the banks sort of overextending themselves in the structured product area, there were calls for just creating the banks as narrow banks, that the banks should only be allowed to behave like utilities, where they only take deposits, which are then invested in government securities, and that's about it. Anything beyond that, like a fractional reserve system-based banking, was considered again a inherent source of instability. And as you know, I mean, in banking literature, going back to Diamond Divig, that issue is there. Ishwar, the one another, I don't know if it's as wonky as the scenarios that you laid out, that in my mind, I want to hear your view, is that if indeed on the margin, issuance of stablecoin generates additional demand for U.S. Treasuries and pushes down U.S. interest rates. I mean, I've heard Scott Besson talk about it. Then, if we indeed have a functional credit channel, we could see additional money demand coming from the lower interest rates. So, could we actually see expansion of money demand on the back of stablecoins issuance?
Again, as with most things in economics, it depends, and it's going to depend on the sort of interest rate environment we are in, whether stablecoin issuers are allowed to offer interest. And right now, those are not in the cards. But again, under the Trump administration, anything can change on a dime. But certainly, there is some legitimacy to the notion that because we have a very crypto-friendly administration in Washington, and given that stable coins, as I mentioned earlier, are a very useful bridge between traditional finance and decentralized finance and the different areas of decentralized finance, we could see greater demand for stable coins arising just from the US financial system. But then if the accessibility of stable coins leads people in other countries to start demanding stable coins for payment or even potentially as stores of value, because at least it doesn't fall in value in dollar terms relative to their own currencies, then you could end up with heightened domestic as well as foreign investor demand for stable coins. And yes, this is going to have two important secondary effects. One is that it's going to make the dollar even more dominant as a payment currency and potentially even as a store of value. And second, it is going to increase the demand for U.S. treasuries, which at some level is a good thing because right now the Fed, is continuing to roll off U.S. Treasury securities from its balance sheet. The U.S. is going to have very large deficit financing requirements. So it is quite likely that this is going to be good for the U.S. in terms of generating additional demand for U.S. Treasury securities. It does create some potential fragilities in the U.S. Treasury securities market as a result of stablecoin issuers holding a lot of them, because one could start thinking about concerns about what happens if, sort of like a bank run, you have a run on a stablecoin issuer. In principle, it should not happen because stablecoins is supposed to be fully backed, but one can well imagine scenarios in which that happens.
It's interesting you mentioned scenarios. A couple of years ago, I had a conversation with Augustine Carstens, who was then the general manager of Bank for International Settlements. And Augustine was telling me that stablecoins is a half a millennia old concept. So I sort of was a little quizzical. And he said that the Dutch East India Company used to issue copper-backed paper, which basically acted as a stable coin. It went on pretty well for about 80, 90 years. And then the governance around holding the right amount of copper to issue the right amount of claims sort of started getting little, undone. And then once the question around whether they actually were holding that much copper or not came about, the stablecoin experiment, which lasted a century, sort of fell apart. So I want to, sort of talk a little bit about BIS because they've written a couple of papers on this. And I believe, if I'm getting it right, 3 tests of a currency. Ubiquity, that if a monetary authority issues a dollar, backed by the Treasury, every dollar is the same, interchangeable. Second is elasticity, that a monetary authority can do open market operations or any other form of tools that they have to deploy to change the scope of money demand and so on. And finally, security, that they have the power to legislate the integrity of the currency regime and go after various sort of breaches of illicit usage of the currency. So ubiquity, elasticity, and security. Do stablecoins meet these 3 tests?
That again depends on who you ask. Stablecoin issuers will tell you that they do ensure that they are fully backed. In fact, one of them, the largest issuer of stablecoins, Tether, has argued in some contexts that it is over collateralized, meaning every unit of tether is backed up by little more than $1 worth of liquid securities. But in fact, that used to be the biggest concern about stablecoins because you were left to take Tether's word for it. What the Genius Act passed in the US has done is to systematize the way in which stablecoin issuers are supposed to report and get their holdings audited in order to build more confidence in the sector. But the interesting thing is that even though many people, including myself, had some doubts about the backing of Tether, the market seemed to take them at face value. For a number of years now, Tether has traded at pretty much on par, except for very minor, very temporary deviations. Now, one might argue just the fact that there are minor and temporary, but still deviations from par suggests that these are not fully secure. So I think there are still some questions about that. The other issue worth thinking about, I should mention that the second largest issuer of stable coins, which is a Circle, which issues USD coin, but also coins in euros and Japanese yen, has been much more transparent about its reserve holdings and so on. And in fact, they've been much more eager to get this sort of regulation because they feel that it would bring all stablecoin issuers in line with the need to be very transparent about their reserves. There is one question implicit in what you just mentioned, Taimur, which is that when you think about the central bank issuing money that is in use as a system of payment, that is a liability of the a central bank, and the central bank, of course, is in a sense backed up by the taxing authority of the government. If you think about a commercial bank deposit, that is a liability of the commercial bank. The commercial bank is backed up by the deposit insurance system, but more importantly, the commercial bank does have access to liquidity facilities from the central bank. So commercial banks in the US do have access to liquidity backstop from the Fed. A stablecoin issuer doesn't quite have that backstop. So if there were to be a concern about a stablecoin issuer, if people was to start getting a little concerned about whether in fact the securities that stablecoin issuer says it holds are in fact there in the vault, or if they are high quality assets or if they're liquid assets, one can well imagine a run on a stablecoin issuer. This could have two sorts of effects. Number one, it could create a problem in the treasury securities market. If in fact a stablecoin issuer has a lot of backing in the form of US Treasury securities, those securities have to be redeemed. And right now, the amounts we're talking about in terms of stable coins, somewhere around 280, $300 billion, and not that much. But if that number grows to a significant amount, if a stablecoin issuer is trying to redeem treasury securities to a significant extent at a time when the government in the US is trying to issue a lot of new treasury securities to finance its debt, and given all the liquidity problems that have already been in the treasury securities market in the last few years because of changes in the market maker structures, suddenly you could have a potentially adverse liquidity event in the treasury securities market. If that were to happen, and a stablecoin issuer typically doesn't have the liquidity backstop from the Fed, you could immediately set off a lot of trouble in the US Treasury securities market, which is a benchmark for the entire US financial system, which in turn is the underpinning of the global financial system. So one can very easily see these risks spreading through US financial markets into world financial markets. It's not a clear and present risk yet. But with the legislation in place, with stablecoins likely to proliferate, I think it's definitely worth keeping one's eye on these risks.
How would you solve for this risk?
It's a tough question. The legislation is supposed to do this. Now, one way you could reduce the risk is do what commercial banks benefit from, which is having a liquidity backstop with the Fed. But now you have the Genius Act, which doesn't give the central bank the authority to regulate stablecoins. So we might actually be in a worse situation if this legislation were to, develop in a way that stablecoin issuers get even more of what they want, which is a liquidity backstop from the Fed, which makes them look even safer without being subject to the tight regulation by the Fed. So I worry that given the political environment in Washington, we could end up giving, the entire crypto world, including stablecoin issuers, a lot more if they want, without the safeguards being in place. And I think the BIS is right to caution us about all of these risks, which might seem like they are well off into the distant future, but I think could start hitting us in the face sooner than we might expect.
Absolutely. Ishwar, you wrote a very sort of insightful op-ed in the Financial Times over the weekend. I also saw yesterday Jean Tirole has written an article. If I were to sort of push the two articles through Gen AI and ask them to sort of create a sentiment indicator, they probably, I think, would say that yours were more on the optimistic side about the persuasive use cases, and Jean Tirole's was slightly more on the worrisome side that governance around cryptos and stable coins and the risk of breaking the bank of a tokenized money market fund, which is essentially a stable coin. Those sort of risks could be quite substantial. So let's first talk about Tirole's argument, and then I want to come back to yours because yours has a more of an international dimension. I want to talk about that later on. So concerns about run, breaking the bank, and that sort of stuff. In an international setting, do we need some sort of an international coordinating body that oversees the blockchain-based transactions? Because if things sort of move from SWIFT to the blockchain, who has the oversight, and how do we then sort of enforce regulations?
This is one of the very complicated issues with cryptocurrencies in general, that they do not know any borders, and they make it very easy in principle to get around capital controls. There are ways that countries can limit their households, their businesses' access to cryptocurrencies by limiting the connections between traditional financial institutions in those countries, especially banks, and having anything to do with crypto. The Indian government, for instance, along with the Reserve Bank of India, India's central bank, had essentially banned cryptocurrency dealings more broadly, and then banned Indian banks from having any sort of dealings with cryptocurrencies. Some of those rulings were pulled back because of a Supreme Court ruling, but government central bankers can make it a little harder for traditional financial institutions, where most people still keep their money, to facilitate cryptocurrency transactions. Now, once you have a jurisdiction like the United States, legitimize stablecoin transactions, it's going to be much, much harder to corral. So yes, in principle, it would make sense to think about coordinating these at the global level. But given the state of global governance these days, and given the geopolitical fissures that are, expanding in around the world, I think it's going to be very difficult to come up with a coordinated regulatory approach, because advanced economies, emerging market economies have different perspectives on this, different levels of regulatory expertise, exposure to different risks. Even among advanced economies, going back to the example of the euro I gave, the US and the euro may have very different views about whether to regulate stable coins, and whether to coordinate on that. Now, Professor Tirole, in addition to some of the risks that I mentioned, and of course he articulated them much more effectively than I could, he also pointed out one more important issue, which is that if you think about the US, where stable coins are now seen as a legitimate, government approved or authorized form of payment, because after all, there is legislation that legitimizes stable coins. One can well imagine that if a stablecoin issuer were to do things like issuing a lot of stable coins that were not fully backed, but people kept using those stable coins, put a lot of money in those, and then the stable coin issuer failed. Just like the failure of a big bang, because it could set up broader problems, there is this huge issue of moral hazard, which is to say that everybody would expect the government to step in, because we know that if the government does not step in, it could cause major financial problems. So it becomes a self-fulfilling prophecy. People trust the stable coins because they believe the government will eventually step in if anything were to go wrong, which allows stablecoin issuer to start doing even dodgier things than some of them might already be doing. So yes, a better regulatory approach at the domestic level and a coordinated global approach would certainly be better. I think the prospects of the latter are pretty dim at the moment.
Indeed, indeed. Ishwar, at the beginning of this conversation, you're talking about the fact that the crypto technology has been around for 17 odd years, and we have not really seen a huge take up other than stores of value, because your point was that crypto prices are pretty volatile. It doesn't really work that way, whereas stable coins can offer a solution. But I wanted to ask you about the ability of the blockchain-based system to absorb a very sharp rise in transactions. And we've seen in the past that blockchain services companies themselves have had to sort of adapt to rise in usage. People talk about the very brown nature of blockchain technology, and as computational intensity rises, energy usage also goes up. And I also recall Ben Broadbent from Bank of England once talking about how the conventional central bank to commercial bank based, real-time gross settlement system can handle hundreds of billions of dollars worth of transactions on a daily basis, intra-second or intra-minute, and very, very low cost. So do you think that the technology is there to remain stable, relatively cheap, and be able to handle an extremely large number of transactions?
As I've said already either once or twice, I think the real legacy of cryptocurrencies is basically in showing us how pervasive these inefficiencies in current financial systems are, especially when it comes to payments, and even more especially when it comes to cross-border payments, and how you can use technology to get around those inefficiencies. So is blockchain the right technology to address those issues? That is a lot less clear to me. Now, again, it's worth getting a little wonky here because there is an important issue about different types of cryptocurrencies. When one hears the word cryptocurrency, you typically tend to think of Bitcoin, which is the granddaddy of cryptocurrency, so to speak, and it did spawn this entire new blockchain technology. Now, the particular consensus mechanism that is used by blockchain, by the Bitcoin blockchain in order to validate transactions is hugely inefficient. It cannot handle a large volume of transactions, especially at the base layer. It is very slow, and also it is quite expensive with fairly large transaction fees. So it's really not working very well. In addition, as you pointed out, the energy requirements for gaining consensus on the Bitcoin blockchain are pretty significant. Now, there are alternative consensus mechanisms that have been developed. The second largest cryptocurrency by market value, Ethereum, uses a very different consensus protocol. It's called proof of stake versus Bitcoin's proof of work. And proof of stake, it turns out, is very efficient. It uses tiny amounts of energy compared to Bitcoin. It's much more scalable in terms of the volume of transactions that can be processed, the latency, that is the speed with which transactions get processed. So those are not the major considerations here. Now, both Bitcoin and this cryptocurrency that I mentioned, Ethereum, are both decentralized, which means that there is no particular institution or organization that runs them. They're essentially run by the community as represented by the computer nodes that have an incentive incentive in the form of fees or in the form of block rewards in the context of Bitcoin to undertake the validation of transactions and to maintain the integrity of the network. If you think about a stable coin, which is also a cryptocurrency, it is completely centralized. So all of the transactions are validated by the stablecoin issuer, who also decides on the rules of the game, who issues the stable coins. So it's a very different setup. So it is a bit paradoxical at some level that the Bitcoin revolution was basically intended to get us away from all of the centralization. So it was supposed to be people power or community power at its finest because there is nobody who runs Bitcoin. It's run essentially algorithmically. Ethereum does have a little more centralization, but it's still basically decentralized. But a stable coin, which really works quite well at what Bitcoin was supposed to do, is in fact centralized in every aspect. So even when we think about blockchain technology, it spans the spectrum from very decentralized to very centralized. The very decentralized version, especially as epitomized by Bitcoin, is not the solution to more efficient payments. Stable coins, which are very centralized, but which are blockchain based payments, are in fact quite efficient, and Ethereum is somewhere in the middle.
Fantastic. Ishwar, you have touched upon use cases a few times, so let's go there a little bit. Correspondent banking, trade finance, remittance, as well as institutional cross-border payments, not just retail remittance. Among these use cases, which one do you find the most persuasive in terms of being able to take advantage of the stablecoin framework?
Now, the question again is why one needs stable coins at all. You mentioned the BIS earlier, and let me make a plug for a BIS initiative, which I have no part in, but I think it was a useful initiative to try to think about how to bring central banks together to use not retail central bank currencies, but wholesale central bank currencies in order to create more efficient conduits for cross-border payments. Now, those could be based on blockchain technology, but they don't necessarily have to be. One can think about tokenized versions of wholesale central bank digital currencies, which are already digital in nature and are used for, right now for payment and settlement across financial institutions, something that most of us don't see, although you, Timur, given your position at DBS, might well actually see. But this all happens in the background, so one can think about this international layer being added to that. Right now, the way correspondent banking is set up is really not terribly efficient. You have the messaging being done through SWIFT, and then correspondent banks which actually have to provide the pipes through which these transactions take place. So if you're, sitting in a village in India, want to send a payment to your cousin in, say, Idaho, or typically it may go the other way, you have to go to your bank, your local bank, which then has to, send the money to a correspondent bank in the US, which then might have to send the money to a correspondent bank in India that it has dealings with, which then transfers the money to the local bank. This adds a lots of steps, is really very inefficient. So one can think about cutting out some of these links so that even smaller banks are able to more directly transact with each other, or at least making the correspondent banking function a lot more seamless. And, one of the key elements that this new technology, blockchain-based technology, can deliver is speed. And when we think about transacting between countries, that is inherently complicated because we're talking about two different monies and there is an exchange rate between them, which introduces an element of risk. In addition to other types of risk like the liquidity risk, the counterparty risk, and so on. But a lot of these typical operational risk can be substantially reduced if you have practically instantaneous settlement, payment and settlement. And I think, again, what the pervasiveness of cryptocurrencies is showing us is that there is no reason in this day and age why payments should not be settled practically instantaneously at the speed of an email, for instance. So I think we're getting to that point, and that will certainly make a lot of this much easier. So, in the Financial Times piece that you referred to, I spoke about why cryptocurrencies are really, especially stablecoins, are catalyzing changes in payment systems, both domestic and international. So, even if they are not necessarily the solution, even if blockchain is not necessarily the solution, I think stablecoins are doing all of us and financial systems a great favor in giving commercial banks, central banks a real kick in the backside to do things better.
So well said, and perfect, transition to my next question, which was I was going to talk about your FT op-ed. Ishwar, in that article, you seem to be suggesting, in addition to the very healthy and timely kick in the backside, that countries that are worried about either banks getting disintermediated or losing control of their own currency ought to basically try to have a banking system and a currency that is stable, does not lose its value, and then people would be happy to hold on to their currency.
Yeah, that's exactly right. You summarized it very nicely, Timur. The point is that rather than this knee-jerk defensive mechanism, the right approach should be to ask, why is it that stable coins are getting so much traction in my country? So when the Eurozone, for instance, expresses great fear about stable coins being a way for the dollar to start playing a role in European financial systems, the question is, why is it so many years, more than 2 decades after the formation of the Eurozone still doesn't have a unified payment system? The European Central Bank is trying to put in place a digital euro, which would essentially be a digital payment mechanisms that would, in principle, work seamlessly across the Eurozone. So the question is, why did it take so long? And then, of course, one can ask other questions about the euro. If there are centrifugal forces that are still, pulling apart the eurozone, how much confidence can people have in the euro? I mean, at a time like this, as Madam Christine Lagarde, the head of the European Central Bank, has correctly pointed out, it should be a fantastic opportunity for the euro because many of the elements of the institutional framework that have inspired foreign investors' trust in the dollar, the independence of the central bank, the Fed, the system of checks and balances, the rule of law, all of these are being undercut in the US. But we don't see the US substantially losing share, although by all logic it should, simply because other currencies, other financial systems have even greater weaknesses. So I think this is a good moment for those countries, those central banks, those governments to ask, why do our financial systems, why do our banks still have all of these fragilities, and what can we do to fix them? So maybe that should be another kick in the backside, to try to get their domestic financial systems, regulatory systems, and so on in order.
Countries like China and India have capital controls. They have both regulators have shown quite a bit of pushback and skepticism about the blockchain-based payment system. Would a ubiquitous world of stablecoins undermine PBOC and RBI's continued fight to keep those capital controls in place?
No, it's worth making an initial point about both China and India. I mean, China and India have leapfrogged, major advanced economies, especially the US, which still has somewhat antiquated payment systems, with their own digital payment systems. In China, Alipay and WeChat Pay are doing a fantastic job of providing very low cost, easily accessible, convenient payment systems for even the smallest of microtransactions. In India, the Unified Payments Interface has done a very good job of providing seamless payment systems that are and that have the added benefit of interoperability, which the two major payment systems in China do not quite have yet. So domestically, things are in much better shape in these two countries. However, as you pointed out, Timur, both of these countries have currencies that do occasionally suffer from bouts of loss of investor confidence. So the two central banks the Reserve Bank of India and the People's Bank of China have been reluctant to completely free up their capital account regimes by keeping in place some capital controls. And that again speaks to some extent to two things. One is the fragility of the financial systems, whether that's perceived or real, is open to debate. I think there is some legitimate concern about, say, deposit flight from either of these countries if there were to be some major financial paroxysm. But it also speaks to some concerns in both countries that while they're willing to allow for some flexibility of the exchange rate, they don't want the exchange rates to become too volatile because that could create a host of other problems. So the unwillingness to let their exchange rates be truly flexible, which of course is aided by having some capital controls in place, I think does limit the ability of both countries to have their currencies, the Chinese renminbi and the Indian rupee, be seen as true international currencies. And that creates an opening for stable coins, especially dollar-backed stable coins. Again, not that I think that these stable coins are going to get any traction in terms of domestic payments, but in terms of cross-border payments, certainly they could pose some risks to the ability of these central banks to maintain capital controls.
Absolutely. I think we have already seen this play out in Nigeria, where the authorities did try to stop digital forms of payment and app-based peer-to-peer settlements. And I don't think they've been very successful. And if we have a bunch of Indian and Chinese entrepreneurs start offering all sorts of solutions around stablecoins, on-ramp, off-ramp to fiat system, it would be very challenging, I think, for their monetary authorities to step in. Eswar, such an insightful conversation. I can't thank you enough.
That was really fun, Timur. I really enjoyed it. You had all the right questions, and I think we covered a lot of ground.
My curiosity will remain unsatiated. So when I see you in Washington next month, hopefully we can have one more chat.
That would be great. Thank you so much for having me on.
Thank you to our listeners as well. This podcast was produced by Ken Delbridge at Splice Studios. Violet Lee and Daisy Sharma provided additional assistance. Kopi Time is for information only and does not constitute any investment advice. All 160 episodes of the series are available on YouTube and on all major podcast platforms, including Apple and Spotify. For our research content and webinars, you can find them all by Googling Devious Research Library. Have a great day.